Welcome back to the Longacres Finance channel. If you have listened to me in the past, you probably already know that I am a fan of dividend yield theory. Dividend yield theory is a simple but powerful valuation technique, and one that applies only to dividend stocks as the name suggests. More so than that, it's best suited for stable, quality companies with great histories of paying and growing dividends. What I would like to show you today is how you can use dividend yield theory to your advantage when it comes to identifying the right time to invest in a quality dividend stock. Now, I can't tell you this will work all of the time, but when it does, the results can be beautiful. Before we dive in though, help me out by giving this video a like and subscribing to the channel. For my example today, I will be using Hormel, one of the best dividend kings. But before we look at whether now is a good time to invest in Hormel, we have to determine if Hormel is a good business and one that will continue to grow in the future. This should be the first thing you do as a dividend investor. Determine if the stock you are looking to invest in is a great company. Because in the long term, great companies will grow your money and offer stable, reliable, and growing passive income. So let's take a quick look at what's going on with Hormel today to determine if the company will continue to grow in the future. In December, Hormel announced its Q4 earnings, and the news was very good. Total revenues grew 43% year over year, but a significant portion of this growth was a direct result of Hormel's acquisition of Planters nuts. If we back out the acquisition, organic sales growth was still 14%. That's a very good number for this giant food company. This growth was observed across all product lines, from refrigerated foods to turkey sales, that have struggled in the past. The acquisition of Planters was a major investment for Hormel that required issuance of new long-term debt. Prior to the acquisition, the company was free of long-term debt. I think management made a good decision to capitalize on this acquisition and should have no problem servicing this debt in the future. Better yet is the fact that analysts are forecasting top-line and bottom-line growth to continue for Hormel in the future. 2022 revenues are projected to be over $12 billion, which would be a new all-time high for the company. Bottom-line earnings are forecasted to be just shy of $2, which would also be a 14% increase from 2021. Hormel has been around for a very long time, and they have a very good management team. I think the business will continue to deliver for investors well into the future, and the recent acquisition, as well as positive operating results, are strong catalysts for future growth. The stock did have a phenomenal return of 17.9% in December to finish out 2021. Obviously, it would have been better to invest in this dividend king prior to this pop. But let's take a look at the dividend yield curve to see if Hormel still presents a good buying opportunity today. What I did to come up with this analysis is I pulled the price and dividend history for Hormel for the last 5 years. I did this by month, which gave me 60 data points to review. I then computed the dividend yield at each monthly interval, and used these monthly dividend yields to compute a trailing 5-year average dividend yield. The trailing dividend yield for Hormel over the last 5 years was 2.02%. Now, if you look online for a trailing historical dividend yield, you may find slightly different numbers. It all depends on how the historical dividend yield was computed. Some sources use average annual yields to compute trailing dividend yields. I prefer to look at monthly data to refine this figure a little more. We could certainly look at daily price histories to get an even more exact figure, but that would require significantly more work, and it's not really worth it in my opinion. Okay, so now that I have the last 60 monthly dividend yields for Hormel, as well as the trailing average dividend yield, I can compare these yields to figure out when the stock was potentially undervalued. Anytime the current dividend yield exceeded the trailing average dividend yield, the stock was potentially undervalued, and vice versa. Looking at the past 60 months, I can see that the dividend yield oscillated above and below the average trailing yield, which tells me that there were more opportune times to purchase shares of Hormel in the past. Here's a chart comparing the actual dividend yield and the trailing dividend yield for the last 5 years. The blue line is the actual dividend yield, and the green line is the average trailing dividend yield. So as you can see, there were 7 occurrences in the last 60 months where the actual dividend yield crossed above the trailing average dividend yield. In 2017, in 2018, again in 2019 it happened twice, in 2020 when the pandemic hit, and twice more in 2021. There are 2 reasons why a dividend yield increases. The first is a dividend hike from the company, and the second is if the share price declines. Now, to test if buying shares of Hormel when the dividend yield was above the trailing average was actually fruitful, I have computed the trailing price return for each of the last 60 months. In this chart, you can see the potential over or under valuation represented by the blue line, and the cumulative price return represented by the green line. We can clearly see here that anytime dividend yield theory suggested shares were undervalued, meaning that the blue line was below 0%, the cumulative price return, the green line, spikes. The green line is a cumulative return, and you may notice that it trends downward as we move from left to right. That's because as we move across the last 60 months, the cumulative return on the left represents longer time periods. So the first point on the left shows a full 60-month return, the next is for 59 months, and so forth, as we move from left to right. The key is to pay attention to the correlation between potential undervaluation and higher cumulative returns. This chart tells me two things. The first is that buying and holding shares of Hormel would have worked out well during the last 5 years. All of the cumulative price returns from 2017 and most of 2018 look pretty attractive. Keep in mind that this does not include dividend payments or reinvestment of those dividends. The total cumulative return would surely have been higher than the price return in the chart. The other thing I can tell from this chart is that investing capital into Hormel when dividend yield theory suggested shares were undervalued led to better price returns. This correlation can also be represented as a function of the actual dividend yield. Here we have the cumulative price return, the green bars, graphed against the actual dividend yield over the last 60 months. As you can see, anytime the dividend yield spiked in the past, the resulting return of investing at that point in time was more beneficial than when the dividend yield was below the average. Again, the cumulative returns on the left hand of the chart are for longer periods of time than those on the right hand of the chart. Obviously, investing 5 years ago is better than investing 5 months ago, given that Hormel continued growing during this period of time. The important part here is that the cumulative return increases as the dividend yield increases. Investing in Hormel at the beginning of 2017, when the dividend yield was below 2%, led to long-term price returns in the 35% range, while investing in Hormel in late 2017, when the dividend yield was above 2%, led to long-term price returns closer to 50%. This suggests that when the dividend yield for Hormel is above its trailing average, investors stand to achieve better long-term returns. The last chart I want to show you is a comparison of the actual dividend yield for the last 60 months and the annualized total return for the stock, assuming you invested at each monthly interval. This is a more normalized comparison than the prior chart we looked at. Here you can see that the long-term annualized returns follow a similar pattern as the actual dividend yield. When the yield is better, the long-term annualized return is better. There's no data for the last 12 months, since those time periods don't have a full year to compute a meaningful annualized rate of return. Based on these charts, October and November were excellent months to pick up more shares of Hormel. But even today, the dividend yield of 2.1% is above the trailing dividend yield. Based on historical patterns, investors stand to achieve better than average long-term returns at today's prices. I think the recent strong performance for Hormel may push the share price higher, and we may not have too many opportunities to trade above a 2.02% trailing dividend yield. Now, this doesn't factor in any macroeconomic factors that may affect the entire market and cause Hormel's share price to decline. I think the company is a great long-term dividend play, and today's share price looks attractive. Hormel has increased its dividend for the last 56 years. That's a very long history of steady and growing dividend income. This pattern should continue well into the future. The dividend growth rate has been cooling off lately. Between 2010 and 2020, investors enjoyed very strong double-digit annual dividend growth. Last year, the annual growth rate dropped to 5.38%. Hormel already announced its new dividend for 2022 at 26 cents per share. If the dividend remains fixed at this rate for the entirety of 2022, as is expected, this would result in a 6.12% annual dividend growth rate for 2022. A double-digit growth rate would be nice, but a 6% growth rate after 56 years of dividend growth is still a very respectable mark to hit. Let me know if you like Hormel, and if you like this dividend yield theory analysis for the stock. I may do more in the future if you guys enjoy it. Thank you for watching, see you next time.